Welcome to The Explainer. I'm so thrilled to have you here. If you're a focused learner, someone really looking to unlock the true financial mechanics of running a UK franchise, well, you are in exactly the right place. Today, we're going to look way past those glossy marketing brochures and dig right into the actual numbers. Running a franchise is so often pitched as this perfect plug-and-play operation, right? Like a guaranteed path to profit. But behind the scenes, the accounting required to keep a franchise both compliant and profitable is genuinely, uniquely complex. So let's break down exactly how you can protect your margins and really optimize your tax position.
Here's our roadmap for today's Explainer. First up, we'll look at why a franchise is not your normal business. Then, we'll dive into structuring your franchise. Third, we'll hit the reality of royalties. Fourth, we'll talk about unlocking capital allowances. That's a big one. And finally, avoiding those costly compliance traps.
All right, let's jump right into Section 1. Not a normal business. The dual accountability squeeze. So, is a franchise just a regular small business? We really need to start by shattering this illusion. It's not simply a plug-and-play business in a box that operates just like any independent startup. Not at all. It's actually an environment of dual accountability, and that creates a very specific, kind of intense financial squeeze. Most people assume, hey, if I own the franchise, I just track my income, deduct my expenses, pay my taxes, and keep the rest, right? But treating it like a standard small business, that's literally the first major mistake you can make.
Think about an independent SME for a second. They have total freedom. Flexible pricing, which means they can adjust to inflation instantly. They could choose literally any supplier they want to cut costs, and they set their own internal reporting rules. But a franchise model? It's vastly different. You're dealing with fixed margins where the franchisor often dictates the pricing. You have restricted suppliers, so you can't just, shop around for a cheaper alternative on a Tuesday. And you have mandatory, highly specific franchisor reporting requirements. This dynamic creates a severe margin squeeze. You can't just randomly raise your prices to cover a bad month.
So, the crucial point is this. You don't just answer to HMRC, you also answer to your franchisor. You've essentially got two distinct masters tracking your finances. One wrong accounting decision doesn't just mess up your tax position with the government, it can actually breach your franchise agreement and threaten your entire operation. Your books have to be absolutely spotless and perfectly aligned with two very different sets of rules.
Moving on to Section 2, structuring your franchise, laying the foundation.
Because the stakes are so incredibly high, your early decisions dictate your flexibility for years to come. And the most critical early decision every single franchisee has to make is about their legal and tax structure. Take an LLP, or limited liability partnership. It operates under a private agreement. It doesn't directly pay tax on its profits. Instead, the partners are taxed individually. The beauty here is flexibility. You can change profit-sharing arrangements every year without triggering some massive tax charge. But then you have an LTD, a private limited company, that has public articles of association and fixed share capital. It's treated as a totally separate taxable entity subject to corporation tax, and it is much, much harder to change that ownership-dividend ratio year over year.
Okay, let's dive into this, because while an LLP is super flexible, the rigidness of an LTD can actually be a massive advantage, depending on your goals. An LTD is generally the superior choice if you're planning to scale. Why? Well, outside investors prefer buying and selling share capital. Plus, an LTD structure lets you access powerful tax incentives like the Enterprise Investment Scheme, or EIS, which gives outside investors a massive 30% tax break. You can even set up HMRC-approved share schemes to retain your top talent. Basically, if your goal is to build a multi-unit empire and eventually sell it off, the LTD is absolutely your foundation.
All right, Section 3, the reality of royalties, managing margin leakage.
Constant margin leakage is just a fact of life for franchisees. But before we even get to the ongoing royalties, we have to talk about the initial fee. There's this accounting standard called FASB Topic 606. What this means in plain English is that the massive upfront fee you pay, say £50,000, is not just a simple day-one tax write-off. No way. Your franchisor has to allocate that fee across specific services, like training, site selection, or equipment setup. As the franchisee, you have to capitalize that initial fee and amortize it over the term of your agreement. I know, it's a bit of complex accounting jargon, but it fundamentally changes how your business looks on paper in its very first year. Now, what's really interesting about how these payments break down is how systematically HMRC views your different franchisor payments. Look at your ongoing royalties, usually a percentage of your sales. Those are generally deductible as business expenses as they happen, and they attract standard rate VAT. But look at marketing contributions. They're only deductible if they're used for genuine marketing that benefits your specific business. If the franchisor just uses that money for general corporate brand building, the tax treatment might completely change. You have to track these separate streams with absolute precision.
Let's head into Section 4, Unlocking Capital Allowances, Finding Hidden Tax Value. This is arguably the absolute most lucrative part of our explainer today. We're going to reveal how to claw back some serious cash from expensive commercial setups. Consider a high-end restaurant interior. A commercial fit-out can easily cost £4.75 million. To the untrained eye, it's just beautiful decor and a functional kitchen, right? But to a specialist franchise accountant, it is packed with massive, hidden tax value. Literally everything from the specialized ventilation, the ambient lighting, right down to the specific plumbing for the espresso machines. These are qualifying assets.
Let's move on and see how this builds into real money. The UK offers incredibly powerful capital allowances. You've got 100% full expensing for main pool plant and machinery, meaning corporate tax-paying companies can deduct the full cost immediately. Bam! Then there's a 50% first-year allowance for special rate pool items. And the annual investment allowance, or AIA, gives you 100% relief up to £1 million. But here's the catch. You have to identify, value, and accurately pool these items. If your accountant just lazily lumps the whole fit-out under building costs, you lose out entirely. And this brilliantly illustrates why that matters. The true financial impact here is just staggering. On that £4.75 million restaurant fit-out we just discussed, correctly applying those capital allowances yielded a massive £1 million in actual tax savings. £1 million clawed right back into the franchisee's cash flow, simply by having the right financial expertise to identify qualifying plant and machinery allowances. Honestly, that is the difference between a franchise that thrives and one that totally starves for working capital.
Finally, Section 5, Avoiding Compliance Traps, Protecting Your Profits.
So even if you structure perfectly and claim every single allowance, operational pitfalls can still easily drain your cash. Here are the top costly compliance mistakes we see over and over. Number 1. Incorrectly calculating royalties. If you accidentally include VAT in your gross revenue figure, you are quite literally overpaying your franchisor. Oops. Number 2. Delaying VAT registration. Franchises can scale incredibly fast, and hitting that VAT threshold quicker than expected without registering, that leads to heavy HMRC penalties. Number 3. Mixing personal and business expenses. In a franchise, this isn't just sloppy bookkeeping. It can actively breach your franchise agreement. And number 4. Using an accounting system that just doesn't talk to your franchisor's dashboard. It creates endless admin headaches and reporting failures. Because your pricing is fixed, remember. These tiny leaks will completely sink your margins over time. I want to leave you with this final, really provocative thought. Are your books ready for an HMRC audit and a franchisor review? Because as a franchisee, you are always walking this tightrope between two highly demanding entities. If you aren't absolutely confident that your revenue recognition, your royalty calculations, and your capital allowances are perfectly documented, well, it might be time to evaluate your financial systems. Protect your margins, demand specialized accounting, and make sure your franchise is working for you, not just for the taxman and the franchisor. Thank you so much for joining me on this explainer, and keep learning.